We're getting more technical indicators that suggest a new bullish intermediate trend is beginning, but they're not quite all flashing green yet. I'm going to show you which ones aren't today and how that impacts our expectations going forward. Crude oil showed a little bit of a bearish technical pattern. Today's trade idea looks at that and how we might be able to take advantage. Let's go ahead and get started. Today is Monday, May the 7th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those of you watching for the first time. Thank you for joining us. Keep coming back for more. Subscribe to our YouTube channel. Mouse over the logo in the bottom right corner of your video and then click on that red subscribe button. Also, click the thumbs up icon down below the video. That lets me know that you like today's video and you want me to keep doing them again day after day. Comment on anything that stands out to you from today's video. You can do that down below, further down the screen. And finally, join our daily Market Outlook email. You'll see a link to do so in the video description. Follow me on Twitter for more content like this throughout the day, throughout the week. You'll see my handle up on the screen here at DavidSettle42. Like and retweet tonight's Market Outlook tweet, always pinned to the top of my timeline. Join our Market Outlook community on Facebook. Again, the address at the top left corner of your screen. There's also a link down in the video description that will take you there as well. All right, let's start off by taking a look at the S&P 500 here. And you can see when we take a look at today's action, we kind of stalled. Now we are above the moving average. That's why it's turned green. It's rising and we're above it. So that's positive from a trend. You notice we only had that one day here and one day here during this pullback that we've had. So positive a move that we haven't gotten very often on the S&P 500 in the past few months. The intermediate line's up above 50. It's rising up above 50, which is bullish. You notice hasn't quite got up above that level there. So a smidgen above that level, but really not really breaking above. You probably have to get above 60 before you can break above that level and really clear it. Which has got a good, barring a evening star candlestick pattern here tomorrow, which would be these 2 days with a third day tomorrow being as filled in as black a candle as this candle was, as red a candle as this candle is white. So we'll see if that ends up happening on this Iran deal announcement that was that's talked about here today. You can see we have on this bullish move here. We got the near-term line to help confirm it, getting up above 80, getting into up to 89. That's a positive development for the bullish trend. The momentum line pulled back, but as long as it doesn't pull back to extreme lows, it's okay. Now that it's coming back from the extreme high, we don't really care what the momentum line does. Other than now that we're on this bullish posture, anytime it dips its toe under 20, just not to an extreme, but if it dips below 20 while we're on this bullish posture, especially if the near-term line is also below 50, it's a great buy the dip signal on a trending move. Short-term pullback on a trending move, buy that dip and keep on trending. All right, so right now we're not getting that, so it's not a big concern. But the reality is now, we've held yesterday's or Friday's move, that big strong move that we didn't pull any of it back. We kind of held those gains and a little bit more today. Weren't quite able to get up above last week's high. That was a tweet that I sent out here earlier today. You can see that we were kind of trading in the range of above yesterday's high, Friday's high, but below last week's high. So we're kind of stuck there, and that's kind of where we ended up finishing today's move. If you take a look now at some of these other indexes, here is the Dow Jones Industrial Average. Pull it out just a little bit so we can see it better. Same posture, not above 50 in the intermediate line. We are getting the near-term line confirming that spike on the momentum line Friday. The near-term line now getting up in the reversal zone too, but again, until that intermediate posture really gains some traction up above 50, it's a tenuous bullish posture. We can look at the NASDAQ composite, pull back on that one a little bit so we can see it better. Much stronger bullish posture, much stronger move, clearing last week's high, unlike the S&P and the Dow. Now approaching this April 18th high point here, where my cursor is. So kind of getting up to that point. But again, same thing, short-term sentiment. You have kind of this dual confirmation here with the spike in the momentum line on Friday and now the near-term line getting into the reversal zone, both positive signs from a short-term posture to help solidify the intermediate trend. That's a little bit stronger now on the NASDAQ than it is on any of the other large cap indexes. You can see, this line here didn't quite, well, it got a smidgen above 50 there. So if you count this as a new intermediate high point, then those are our intermediate peaks, and we have to clear that peak here, the last intermediate high, as brief as it was above 50, the last intermediate high. We're coming up off of a higher intermediate low. We expect there to be a higher intermediate high because of that. And then again, the Russell 2000, we'll zoom out on that one. A little bit more bullish. Unable to quite get it above that trend line yet, but we're up to it, up above a rising moving average. This is the strongest intermediate posture as it's to almost 70. So a positive development there. You notice it never did pull back below 50 on this pullback. So this is all, this is the intermediate low point. So a little bit of for those of you that are IBD aficionados, a little bit of a cup and handle formation here where you get a dip, which is the dip here on the intermediate posture, and then more of a minor pullback that wasn't enough to produce a new significant intermediate low that we'd expect now to break up through that. So we'll see if that ends up being the case. So you can see it's trading at the resistance level, not quite there. See, the momentum line didn't spike because we pulled off of the high, and we pulled off the high again today. So we're not able on the near term on the Russell 2000. We haven't really closed right at the high point except for that day right there. A lot of longer upper shadows in all of this, and of course the down days being a lot more significantly off the highs. So a lot of moves off the highs have kept the momentum line down, and the near term line is in the reversal zone, not quite as solid as some of the others. However, we have closed above yesterday's high point, closed above all of these highs. Whereas Friday we closed above most of them, and that one only by a smidgen. So solidifying that breakout today, closing above multiple weeks worth of highs. Now we just, again, like the Dow and like the NASDAQ, have to get above that particular high there, and then we'd feel stronger about this intermediate posture lasting the expected 1 to 3 months and being more towards the 3-month time frame because of the market sentiment being at a better launching point, being below 50 on a lot of these other major indexes here, like the S&P 500. See how it's so below 50 there. Better launching point for a longer potential intermediate run than normal. Longer within the range, the normal range. That 1 to 3 month is a normal range, so kind of expecting more towards that 3-month time frame. Remember, those of you watching on our blog, you can see it embedded here in the YouTube video. There's a little bit of a summary paragraph right above that, as well as a link to discuss in the forum. But also 3 clicks. 3 clicks tell me you want me to keep doing this. And you can do these 3 clicks while you're watching here. First is here on Twitter. You just click that like button. You can also share it with your friends by retweeting. The second click is to like it here on Facebook. Those of you who have Facebook accounts, click on that like button. And the third click's here on our blog, clicking that green button there. Those 3 clicks, while you're watching right now, you can do it right now while you're watching, tell me, number 1, that you got some value out of it. And also tell me, number 2, you want me to keep doing these videos day after day. Brandon and I to keep doing these videos day after day here on YouTube. If you haven't joined our Daily Market Outlook email list, you can do so also while you're watching right down below those 3 clicks. All right, if you take a look at the long-term moving average, today with today's upward move, we finally got the green arrow that we haven't got over the last, 1, 2, 3, 4, 5, 6 weeks. We haven't got that green arrow. In 3 of those 6 weeks, we were sitting smack dab on the 50-day moving average, and that 4th one being pretty darn close. So the last 4 weeks, we're about as close to that 50-day moving average as you could be without ever crossing on the close on Friday. Obviously, this is not a close on Friday, so that's why it's not, it's not set in stone yet, but a positive development to finally get that green arrow. And of course, getting back above the 50-day moving average and pushing up into this mess over here will bring that MACD up. I don't think we'll bring it up back to these levels, and I still think it's going to downtrend its way towards 0 and grind its way towards 0 as these lines move closer. I just don't think Next week and the week after that are going to be those times. I think we're going to pull away a little bit with an upward direction and bring that line back up. Again, within the trend, within the downward trend of eventually grinding towards zero. But that grinding towards zero can last, as you saw in 2015. That grinding towards zero can last here weeks and months with multiple upward moves in there as we pull back and go up, pull back and go up, pull back and go up. When you look at the 3 green arrow chart, you see we got 3 green arrows today. So the MACD finally gave you that 3rd green arrow. We're above an upward trending moving average, and the stochastics is rising from what would be a phantom green arrow. So all very, very positive developments there. If you look at the 3-line version of this, you can see now the 8-day moving average here. Let me zoom in on it. The 8-day moving average, which is in green, the 30-day, the 17-day moving average in red, they're both still above the 30, which remember is a positive development. That's usually kind of the next stage of switching from a bearish divergence to a bullish divergence on the moving averages. A convergence being when they line up like this. So that's what the MACD stands for. Moving average convergence divergence. So here's a moving average convergence, here's a divergence, and usually we go from bearish divergence to bullish divergence pretty quickly. It's not too often we get a convergence coming off of a bearish divergence. But that last stage in that reversal is to get both lines up above 17. So we've already got that. Getting the 8 back above the 17 will be a positive development. That will get this blue line, which is the actual MACD line, down here up above 0. But, again, you can see they're both below 0, the MACD and its moving average down here. But the MACD has crossed above its moving average, just like the stochastics has crossed above its moving average after getting this phantom green arrow. So, again, these aren't the most bullish signs. They're weakly bullish from when you're looking at it from this perspective. But getting the 8-day just about, the fact that they're both above the 17, the 8's almost above the 17, price is above both, just like it was on Friday. Getting the MACD above its moving average, getting the stochastics above the moving average, even if the MACD is not above 0 yet, stochastics not above 50 yet, the 8's not above the 17 yet, so there's still not everything yet, but we're starting to see more and more positive bullish signs here to tell us that we're coming up off of this higher intermediate low point here. All right, when we take a look at the 4-week range, here's the last 10 days, which actually happens to include the 4-week range, because the high was here, back here on last Tuesday, and of course the low was last Thursday, or the Tuesday before, and then last Thursday was the low point. So if I were to zoom out on this and take a look at the 4-week range here, you can see, there's the 4-week range, and there's one more week over here. So we've got, this is our high and our low. There's today's range in orange. You can see how we're above the 4-week midpoint here at 265.18 right now. And you can see how we are trading in between Friday's high and last week's high point. We're kind of stuck there. Late news coming out that, like I said, Trump is going to announce this Iran deal on Tuesday at 2 o'clock, or tomorrow at 2 o'clock Eastern time. So that kind of pushed. The anticipation is that there's going to be a negative response to this deal, that at least negative market response to this deal. And that's why you have a little bit of a sell-off at the end, even though right before the close, a lot of buying came back in. See the volume back here. So here's most of today's buying. There's, you can see the volume. This is today's opening volume where my cursor is, all buying right off the bat. And then at the end, some selling came in at the very, very end before the last, half hour of trading was all buying. So it kind of pushes back up above and closing above yesterday's high point by a smidgen. So when we take a look at it on a daily basis, you can see today's volume well below average here, and you can see how the average is really declining here in gray. We've been below the average for a long time now. It peaked up here on this pullback in late March and April, but really starting to pull back. And of course, when you look at this on a longer time frame for some perspective, you can see. There we go. You can see how we've got a long ways to go before we get to where we were, the low point we hit. But you can also see too, the highs. We're getting back below the high of 2017. So when the volume was the biggest in 2017 was during the spring, the March, April pullback there. Obviously that's been the high so far in the volume. Kind of a big divergence here. A lot lower volume on that pullback, another sign that will bounce off of this to the upside, and the fact that it continues to grind lower. Very similar, the ATR today, well below half of what today's range, half of what the ATR is. And then when you compare ATR to the current price, continuing to come down. So the direction of volatility, the direction of volumes dropping, the direction of the trading range is dropping. And then we take a look at the volatility index here. For our last kind of look-see, and you'll see here, let's take a look at it on a, let's see, on an intraday basis here, on an hourly chart. Volatility is also grinding down and getting, closing below 50 again, slightly lower low than the last time we got, haven't really pulled up off that low point yet, and then especially the VIX relative to VXV easily breaking below, closing below 90 on Friday, staying down below 90 today, and continuing to push its way a little bit lower. You can see on a daily chart here. Just take a look at a daily chart and zoom in on this. Again, the break below 90 is significant because we just haven't had that this whole time, as well as the continuing closing below 15. Which again, we haven't had consecutive closes below 15 since back here, right before volatility jumped to the upside sharply. All right, so in summary, the market posture is bullish. It's not quite breakout bullish yet, as there's still kind of there's some positive signs there, but not all those signs are pointing to the upside quite yet. But the expectation is that they will, and that we'll start a new intermediate trend that can last a month or two. So with this poll that's popped up in the top right corner of your screen, let me know what you think about today's market posture, yay or nay, and then comment down below in the comment section on YouTube about your thoughts on what we've just talked about. In terms of what's driving the price action today, you can see there wasn't a lot on the calendar. Nothing that was market moving according to Econoday here. From an economic surprise index, we did pull back a little bit because remember this is a rolling 3-month window of data. So things can come on day by day into that 3-month window, but also remember things can go off at the beginning of that 3-month window. So looks like to be the case as we pull back a little bit on this. But you also notice, we are about as negative, and this includes the U.S. Economic Surprise Index. We're about as negative as a whole from across the G10 economies as we are positive just in the U.S. So this kind of shows, again, the disparity and the relative performance that the U.S. economy is having right now compared to its major economic peers. Crude oil continued its climb. You see its last few days, it's really made a strong run, having the best performance among all these different asset classes over the past couple of weeks. You can see here, one second. You can see, get those lines off the screen, that the dollar's also been a strong mover over the last couple of weeks. But with that news on the Iran deal in the afternoon, which has been the biggest, the market was really, really tight until the afternoon. And it was a small move in the afternoon too, but it was really the only mover that we had. And you can see how it impacted crude oil prices. If I were to kind of zoom in on just today, you can see how we had a little bit of a pullback here, and the crude oil had the biggest drop on an intraday basis. You look at emerging markets struggling over the last couple of weeks with the strength in the dollar, gold struggling. You would expect that foreign bonds struggling. You would expect that high yield and preferred stocks, they're more interest rate sensitive areas, lagging behind with the strength in bonds. So bonds have been relatively strong, outpacing stocks over the past couple of weeks, but not outpacing small cap stocks. And you can see that today. Stocks were the best performer today, but it was small cap stocks more than doubling the return of large caps. Everything else relatively flat, except for international areas, both really lagging behind. And you can see that strong dollar having its impact on relative performance in gold, as well as emerging markets and commodity prices pulling back from their relative strength. But long-term bond yields, these are bond prices, so long-term bond yields rising. You remember TLT is the long-term, so 20 to 30 years, which is more economically growth sensitive than, say, like the 10-year, which has got some influence from the Fed's overnight rate hike expectations. Not a lot, but some, more than the long-term bond yields will. This is going to be more tied to economic growth expectations. So as this falls, then the expectation is economic growth is expected to rise. And you can see that in its own chart here that, where the long-term bond yield is below a downward trending, this is bond prices, long-term bond prices is below a downward trending moving average. Its market forecast also rolling back down, the intermediate line rolling back down. It's a slight divergence here on the bodies, but not real significant. This is the fact that we are kind of starting to roll over and roll back down again is an interesting development coming off of a cluster, market forecast cluster that we had on TLT before. So a near-term pullback to Fibonacci resistance, and now the possibility. Of course, you'd have to get below those lows to really solidify an increase in yields. But again, breaking below these low points, and on a long-term basis, you can see even more significant. Breaking below these lows in this area will be significant here. You can see it better now. Will be significant for the direction of economic growth expectations, which is what this would be more tied to. You can see crude oil, a little bit different of a picture here. Let me zoom out on this one so you can see it a little bit better. Strong trend, getting a cluster on the futures contract a few days ago. Long upper shadow today. That's on the pullback on the Iran deal. So there's some signs of weakness on crude oil that's been strong. I mean, we're above and upward trending. The intermediate line is entrenched in the reversal zone. You're getting a intermediate confirmation signal today, and now granted, we're not, we're just barely starting that period. So really, you're looking at this period here. There we go. You're looking at that as the period, but that's, the long upper shadow is usually not the most bullish sign, especially coming off of a cluster. So look for some weakness. Now this has been a market driver, so that's why I'm a little, we might get some short-term weakness before we get that intermediate launch, that intermediate trend launch, because this has been a driver and of the S&P in the short term. So unless some new leadership comes in and continues to drive it higher, if crude oil pulls back on this technical weakness, then we might see the S&P pull back, at least on a near-term basis, until or unless new leadership takes the reins from the energy market. Here's that strong dollar, and it's well up above its moving average. So there's some opportunity here for the dollar to kind of start to weaken up a little bit, because it usually doesn't get this far away. That's a very, very strong move on the greenback. You can see how these moving averages have really diverged away. In fact, the MACD is about as high as it's been over the last year. And if I were to zoom this out a little bit and look over more years, we've been this high before, back at the end of 2016, coming off of the election when the market, when the dollar was very, very, very bullish, and we diverged right there. And then that divergence here, lower highs at very, very high levels, both of them, to higher highs, led to a lot of weakness into 2017. We've seen other times where we've been this bullish too, a little bit of a divergence there, and we had a spout of weakness there too. And then of course back here in 2015, stronger than all of these levels, and of course eventually getting that far away from the moving average it's hard to sustain a trend. I mean, we did, we had a sideways move here and bounced up to an even higher high in 2015. Remember that was such a strong move on the U.S. dollar that we had a pretty much 2 years worth of consolidation because of how big and fast that move was. All right, when you take a look at the different sectors, this has kind of been an interesting story. It's typical of a stronger dollar when you have technology and discretionary leading the way, and they're both outpacing the S&P 500. You can see technology had the best performance today, and discretionary kind of matching the broad market here over on the left. But you can also see, too, that real estate and utilities, which have been so beaten up, they're still kind of lagging the market, not over the last 2 weeks, but lagging kind of over the long term, starting to make its way and showing some strength, as you can see here in the last couple of weeks, and even actually longer than that. But not today. Today was a risk-off kind of a day. Staples has been one of the worst. In fact, probably is not, has been more, if you go longer time, as more of an underperformer over the last 4 weeks. You can see it's really lagging. There's your technology and discretionary. And then, of course, real estate being this kind of lighter blue area right here that I've got my cursor on, kind of lagging a little bit behind the market in the last 4 weeks. And you can also see utilities in purple pretty much matching the market over the last 2 weeks. So when you have these sectors, technology and discretionary, outperforming, those are strong dollar areas. Of course, materials and energy do better in weaker dollar performance, and energy has really done well. Energy stocks have really done well over the last 4 weeks, and I think there's opportunity for that sector to continue to outperform. Whereas if any kind of pullback in the dollar might won't push these sectors down, but on the relative performance might put some pressure on these areas and allow some other stocks the opportunity to other sectors, especially like materials, which has been a laggard, that allow that to start to make its way back, which had enjoyed some run, some outperformance before the dollar strength, and you can see how materials has pulled back in light green because of where my cursor is, because of that dollar strength. There's opportunity for that to rally and energy to continue its rally again if the dollar were to pull back. You remember, the dollar pulling back has generally been relatively positive for stocks, and of course eventually like there has been with the utilities and real estate showing some relative signs of strength after being so weak. You can see on a year basis, there they are. I mean, they were so weak, and they're starting to make their way, and I think you'll see eventually the same kind of rotation in the staples out of XLY, which is the orange line here, into staples. Of course, not tomorrow or the day after, most likely, but eventually you'll see some opportunity as we've been kind of focusing on bullish opportunities in that really beaten up staples area. For today's trade idea, I want to talk about a stock that's kind of representative of just how bullish the energy sector has been. This is Whiting, which has pretty much since early February, Whiting Petroleum, WLL, has doubled, more than doubled its price from $21.38 up to almost $47, breaking through this old resistance level here around 36.5, and really taking off in the last little bit to the point where its directional movement index, a positive, is easily above 40, and that's, last time we had that was back here when it ran out of gas. And the negative is as low as either line has been. That's very, very, very negative. And then getting that long upper shadow today, like the crude oil did, with a strong volume, as you can see there. So, with the ADX, again, which pretty much measures the gap between these two lines, about as big as it's been. In fact, I have to kind of really zoom out to show you some perspective. It just doesn't get this high. The last time it got this high, it ran out of gas, and you can see how strong blue line was, and even the lows were so much higher now than they were even then. We weren't getting as such strong higher lows as we are now. So a lot of strong volume in this area too, as we were running out of gas. So is there opportunity that this particular stock might be running out of gas? I mean, to get 100% plus return is some very, very good outperformance in the last little bit, without being, without trying to do so with a forgiving trade, right? And so that's why I look at the opportunity to do a calendar spread where I can say, okay, you know what? I don't mind going out, and I have to go out a little bit further because we don't have, with this May option 11 days away, we don't have any July options yet. July will pop up once that May goes out. So the only option we can buy outside of June would be the weeklies here, but I can go out to September and look to buy, this $41 strike. Has that 30 delta, it's below 30, and then come out here to June and offset some of the cost of that 41 delta by selling that at $1.30. Now here's the reason why I picked that particular strike. If you take a look at the Analyze tab, here the shaded area is 1 standard deviation move between now and June expiration, which is just a little bit more than a month away. So you can see, here's the current price where we're at. There's the 1 standard deviation move down to 37.5-ish, and 41 happens to be kind of in the middle. So again, there's that level there. In fact, let me slice it to the 1 standard deviation. So you can see there's today's price, there's 1 standard deviation move. So 41, usually it's more like 41.5, but 41's about in the middle of that range. So, we can pull back and then bounce back up and still be you can see how between 1 standard deviation move and the current price, we have positive gains at expiration for this particular calendar spread that we're spending $219. And if we happen to finish at 41, then we make about 100% return on the risk on that investment. Now I've thrown on the break-even prices. I've thrown those on here on the current chart, and you can see, we're also reaching some resistance levels here at these old high points. But you also see this low point, this break-even is right about at the Fibonacci resistance or support as we are to pull back. 41's right in this area, so it's in the middle there. And of course, you can see there's going to be some other old high points that will act as support too. So you can see I've got opportunity to pull back anywhere in this area and still be fine and get a decent return on my risk. And if it keeps going up, then we'll take a loss on this. And you can see it's a little bit more forgiving. It's got to go up past that 47 level and then keep going, which is today's high point, right? That's today's high, that long upper shadow high, which remember, long upper shadows the tops of them tend to act as resistance levels. So we'd have to break up above that, and even then, you can see how the losses to get to 279, we'd really have to go out far, like to get to a $279 loss. So more than likely, if we get to 1 standard deviation move to the upside, we're looking at a $110 loss at expiration, which again would be half of what I'm trying to make on a maximum basis. If we were to pull back and just kind of muck around in this area here, and if we were to hit 41, there would be that maximum return. So what do you think about today's trade idea and market posture? Love to hear, love to chat with you about it. To do that, there's a link that just popped out in the top right corner up there to get to the Market Outlook Forum. So click on that link, it will take you directly there. Let's discuss today's Market Outlook video there with other viewers of the Market Outlook. Remember on YouTube to subscribe to the channel, as well as comment on anything that stands out to you down below. Also remember for more content to follow on Twitter, and then join our Market Outlook community on Facebook. As always, have a great evening. Thank you very much for watching tonight, and we'll see you all tomorrow.